Welcome back to Mortgage Giants. I'm tall, he's taller. Let's talk mortgages.
Yeah, it's crazy. We actually sync this up so we're wearing the same clothes.
It's all well planned.
Yeah, right. Yeah.
Everything, facial hair, it was all planned.
Yeah. We're a pro team here, stylists.
That's right. We run a big ship.
Yeah. High budget.
All right, I have an analogy for you. A little bit ridiculous.
Okay.
So you have somebody who will call and the only thing they want to talk about is what's the lowest rate that you're offering. And then try and get off the phone because they're just looking for the lowest rate.
Yeah.
I try to go through the conversation of well, what are your wants and needs? And we go into all of this stuff and it doesn't seem to matter. I have this theory that even if after all of the questions and everything, we still end up at the lowest rate lender, if we would have just picked the lowest rate lender from the beginning, that would have been the wrong decision. Because I feel like the conversation is the most important part in that situation. And it feels as though just going for the lowest rate would be like if you're coming down the basketball court and you're dribbling, all of a sudden you get to the 3-point line, you turn around and just fling the ball over your head, it goes in.
Right.
Woo! Nobody would have said that that was the right shot to take. Whereas you should come down, you analyze the play, he's open, he's not, pass the ball, get the back, clear shot, make it in.
Yeah.
Could have been from the exact same spot.
Yeah.
But just to focus on that, I feel like you're shutting out so much. And there's a big discussion to be had where, okay, you might save money now, but you might pay for it later. Or you might not even have the option that you actually want after that discussion.
Yeah. That's true. That's hilarious. I'm thinking of that. There's a basketball movie that came out recently. And it was one of the kids. He's always just insisted on shooting backwards. Anyway, yeah, that is, the result can end up the same. But if you don't know why you got there, or if it's not repeatable, or good practices, and feel like you're doing your due diligence, there's a lot of positive things that come from that. So, I actually have two examples.
Yeah.
Okay, so the first, email this morning, client says, hey, our mortgage is up for renewal this summer. It's in August. That's awesome. Already I'm thinking they are planners. Mm-hmm. They know that it's coming up this year. They want to be prepared. Already I like this person.
Yeah.
And then they're saying, and we will have a plan, or part of our plan is to sell and buy.
Yeah.
Okay. Now, this is a prime example where this is not going to be about interest rate.
Yeah.
Because they will get a renewal offer from their current bank. I will ask for that renewal offer to sit down with them and review it.
Yeah.
If those renewal offers are awesome, I will tell them that renewing with their current lender is likely the best outcome.
Yeah.
Don't need to do any paperwork. Let's just give them that advice and talk them through why they are making that decision.
Yeah.
They feel good about it. I feel good about it. It helped them. But if they get that renewal offer and they just hone in on, scan, lowest number.
Yeah.
Perfect. I like that. I like that number. Okay, it's lower than the other number.
Right.
Why wouldn't I take that number?
Yeah.
Okay. But the fact they have a plan to sell and buy is why they should not take the lowest rate.
Yeah.
Let me tell you exactly why. The lowest number on that page will be the 5-year fixed rate.
Yeah.
I can tell you that right now. I bet you $10,000.
Yeah.
Okay? The comparable rate, and what they probably should be choosing, is the 5-year variable rate.
Yeah.
And my guess today, that rate is going to be 1% more.
Yeah.
So let's just say, round numbers, if the fixed rate says 5.2, the variable rate's going to say 6.2.
Yeah.
Why on earth would I take that rate?
Yeah.
Well, if you take that 5-year fixed rate and you do follow through with your plan to sell in, 6 months, maybe you get through, a year, you're going to take that current payment and you're likely going to be in what's called the IRD penalty, interest rate differential penalty.
Yeah.
And the way rates are trending, they should be lower again in 6 months to a year after you sign your renewal. And now the penalty to break that mortgage could be roughly 6 times What the penalty would be is if you took that variable rate mortgage at 6.2.
Yeah.
To break a variable rate mortgage at any time, you're going to take what that interest portion is from your mortgage payment in the month of breakage, multiply it by 3, and you're out.
Yeah.
You're out. Okay? Not to mention there's still portability from the fixed rate, and we don't need to really get into the weeds too much.
Yeah.
But if your mortgage payment is $2,000, there's a good chance your interest cost at that time, let's say it's your second renewal, your penalty is going to be $3,000.
Yeah.
To break a fixed rate penalty when the interest rates are lower than when you originally signed up for it, you can take that $3,000 and it could easily turn into $18,000.
Yeah.
Even $12,000.
Yeah.
That's too much money. That is the difference from $12,000 to $3,000. Like I'm saying, let's be conservative on what that IRD penalty could be.
Yeah.
You're in for an extra $9,000 in a penalty. I guarantee you that you would not have paid $9,000 extra in interest payments from August, your renewal, than the time you sold of 6 months down the road.
Exactly. All of that just to get the lowest rate at the time.
You just paid a bank a penalty that should have been going towards the down payment of your new house.
Yeah.
So that's one. That's the reason why.
And you might not believe that the penalties can get that high. They can.
Dude.
Like COVID, when it dropped, there was penalties $25,000, $27,000.
And we're in Alberta, right, where the average mortgage size is $400 and change. Yeah. We're not talking multi-million-dollar mortgages.
The penalties can be huge on the IRD.
Absolutely. And the IRD, with most institutional lenders, they're using their posted rate, not what you're actually paying for a rate, so those penalties get even higher. Yeah. So that's one example. The next one, we have a client approved with a B alt lender. Circumstances don't matter. Okay. But their rate at renewal on a 1-year term is going to be 7%. And we now also have gotten them approved with an A lender at 5.39%. But 5.69%. So that's a big spread. I know that their plan is to likely try to build a guest house on their property. And that will take at least a year. Building is slow when you're getting into plans and specs and
permitting and
all that stuff. It takes time. So now we have to have this conversation of, do you just keep renewing with the B lender for 1 year at a higher rate, knowing that the plan is to build, or you want just to have that 5-year fixed rate, lower rate, but when you do go to build, if you make it that far, you will be facing a penalty. How certain are you that that's going to be the plan you're going to go with to build? But you will pay a penalty if construction starts at some point over the next couple of years. So higher rate, shorter term, let that work into your plans of construction in the future. Versus, again, take the best rate and know that a penalty would occur should construction actually start. So high rate or penalty, it really is always the conversation.
And sometimes it also comes down to maybe the lowest rate lender doesn't offer the product that you specifically need. So okay, take the low rate, but you don't have the higher purchase plus improvement option. Or you can't do a draw. Or there's so much that could come up to just discount it all by I just want the lowest rate. You got to have the conversation.
Absolutely. A lot of our banks too now are offering really good second mortgage options. So, in the future, if you need to then do a renovation or add a line of credit or, anything like that in the future, you will have access to those products and not have to pay a penalty to get what you need. So, again, the more you disclose up front, your broker will be able to help you avoid penalties. It's not always really about best rate. It's penalty avoidance. So people are also afraid still of what we call monoline banks because they're not Scotia,
walk in.
TD, RBC, CIBC,
Yeah.
like there's not the ones that they see on the street when they're driving around every day. But these monoline lenders do provide lower penalties, even on the IRD, especially on the IRD penalty calculation.
Yeah.
So, that's just another kind of feather in their cap.
They play ball at the same level
Yeah.
as the big banks.
Oh, they're federally insured, regulated banks.
yeah.
Like their money is secured,
Yeah.
just like your big bank is. So there's not any, fear of your mortgage being called,
Right.
or anything like that. So a lot of things to consider.
Yeah.
And it's not just about rate.
Yeah. And you'd be surprised what people have as their wants and needs that sometimes influence things. Like I had a client who the lender they currently had, you were not able to make prepayment privileges without calling and talking to somebody. They hated that.
Totally.
They wanted to go online, have it happen without having any communication.
Yeah.
So when their lender gave them a better renewal rate, that said no, and we sent them somewhere where there was an online portal, they could make the prepayment, because that was a focus for them. They were paying down their mortgage faster.
Yeah.
So that trumped lowest rate.
Yeah.
Like there's a whole bunch of situations where the lowest rate is not
Yeah,
the right move.
That's right. And I mean, if you do have an aggressive plan to pay down your mortgage, but you also want to maybe be building a line of credit up as you're paying it down, because you say, well, we want to pay this down, become mortgage free on our primary home, but then use that equity to get into investments, or we know that kids' expenses are coming up, college. Take that line of credit, and it's always like a nice rule is to apply for credit when you don't need it.
Yeah.
And then, your house becomes your own bank.
Yeah.
You never have to apply for mortgage. You never have to apply for credit lending products ever again.
Yeah.
You have, the mechanism in place that you'll use for maybe ever.
Yeah. And know that like that HELOC product generally comes with a higher rate.
Yeah, that's a higher home equity line. It's like mortgage first, lowest interest you're ever going to get. The second is the home equity line of credit. Then it goes to personal loans and personal lines of credit.
Yeah.
So, getting access to tools ahead of time.
Yeah.
Because if somebody loses their job and now you need to go apply for credit, you don't have a job, sir.
Yeah.
I don't think we should, advance you that line of credit you're asking for. And you're like, well, damn it, I should have applied for it when I didn't need it.
Yeah.
And now I'm secured. I'm insulated. I have a buffer while I get back into the job market.
Yeah.
I haven't done a resume in 20 years. That's going to take me a minute.
Right.
Yeah.
Yeah.
So yeah, it's kind of about that too. There's things features that you can set up for yourself that doesn't cost anything extra.
Yeah.
It's just you might thank yourself someday, or maybe you never need it.
Yeah.
But it's there for you to use.
Yeah. And I guess like the important part to me is like have the conversation with your broker. Again, even if the lowest rate lender is the one you do end up going to, at least you had the conversation. You can cross off all the things like, okay, I don't need this, don't need that. No, I'm not moving anytime. Okay, but
Here's
that
one.
conversation.
You're at renewal, and your lender is going to offer you 5.24%.
Mm-hmm.
But your amortization has to stay the same. You can't make any changes to your remaining period to pay that loan off.
Yeah.
But you're drowning.
Yeah.
Your expenses are high. You have some extra, circumstances that may be long-term, maybe temporary.
Yeah.
But right now you are in pain.
Yeah.
By switching to a different lender and pushing out the amortization, even 5 years, maybe 10 years, your rate might go from 5.24%, might go to 5.64%.
Yeah.
But you've just lowered your monthly expenses by $800.
Right.
Is that worth it to you?
Yeah, of course.
Is that something worth talking about? At least exploring. And then if you didn't have that conversation and you just signed and you still continue to feel that pain and now you're actually getting desperate, if you then knew that you had an option to bail yourself out, that will haunt you forever.
Yeah.
You now had to sell a house. You had to maybe make a massive change.
Yeah.
And you had a way out.
Yeah.
That would haunt me.
Sure.
That would be
Or like, what if you even didn't have to sell, but you had to break the brand new 5 year that you just renewed into
to do a
refinance and like
totally. Yeah.
You know?
Yeah, that's right. And now you're paying that higher rate anyway, but you just had to, you're getting that
$10,000
$10,000
or whatever.
payment.
Yeah.
That's idiot tax.
Yeah.
Exactly.
Exactly.
Damn it, that would piss me off. So shoot, man,
Have the conversation.
Have the conversation. Understand that there are ways to be proactive.
And with a mortgage broker, so that you can run through all of the options.
Yeah.
Yeah.
Yeah, for sure. So, yeah, that's a good one. A little bit of a higher rate, or don't go with the fixed. At least take the higher variable. We're projecting that rates are coming down 1% this year, and then at any point you can always convert a variable to a fixed.
Yeah.
So like talk about flexibility.
Yeah.
Doing your due diligence, man.
Yeah.
So yeah,
Sometimes the higher rate makes more sense.
yeah,
So-
yeah, for sure.
Don't count it out.
Yeah, and we're free. Like a broker is free to have that conversation with.
Yeah.
Like.
And a good broker will happily have that conversation
Yes.
without getting anything in return.
Yes.
So-
If we give you good advice, we want you to become a fan
Yeah.
and say that, like, look, this was helpful. They got us out of a bind. They gave us truly honest, unbiased,
Yeah.
advice. And then you will refer, ideally.
Yeah.
We say, hey, we will give that same level of service to your friends, your families, your coworkers. And that's the name of the game.
Yeah, for sure.
Yeah, we only have one reputation, and we try to just make sure that we're always on top of providing unself-serving advice.
Yeah, exactly.
Yeah,
Higher rates sometimes makes more
it
sense.
definitely can. Yep.
All right, thanks for watching. Thanks for listening. Yeah, I forgot we mentioned last time. We're on Spotify now.
We're on Spotify. That's cool. I like that
I
because
know.
I listen to audio only.
Yeah.
I don't watch anything because like my podcast time is driving.
Yeah.
Yeah, so that's exciting.
I know, it's cool.
Yeah,
So
yeah, right on.
listen there too.
Yeah.
All right, we'll see you next time. See ya.
See ya.